Good evening, friends, and welcome to Fund Manager Fridays with 5paisa.com. I'm Deepika Asthana, your host for the evening. Now, when it comes to the stock market, I think all of us always associate stock market with a lot of frantic activity, lots of buying, selling, when to buy, when to sell. But along with all of this activity, also comes the stress. Ki bhai, have you bought enough quantity? Is this the right time? And I also think many of us go through this thing where, अरे market तो बहुत भाग रहा है, लेकिन our investment is not doing well or it's not doing in line with the market. And today we're going to be discussing how you can actually take advantage of the potential of equity investing, but maybe not with the associated risk or stresses which you would usually keep in mind when you talk about equities through the passive investment strategy. And joining us today to talk about the markets, his view on the market and sectors that are looking good, and how we can take advantage of any opportunities in the market through passive investing is Mr. Chintan Haria, Head of Product Development and Strategy at ICICI Prudential AMC. Um, Chintan, welcome. Thank you today for joining us.
Thank you, Deepika. It's always my pleasure. Thank you to all the viewers also.
Lovely. So I think, Chintan, everybody, with the way the markets have been rallying for the last 18 months, we would love to hear your view on the markets, about the current rally, the strength of the rally, where we're going to head from here, and of course, sectors that you feel will give good potential wealth generation opportunities in the over the next 2 to 3 years.
Yeah, so I think one thing which the markets have done is basically made everyone's Diwali very bright in terms of the last 15 to 18 months, what we've seen. Even last Diwali was pretty good because what we were expecting after the pandemic struck in March 2020 that things will look really bad. Yes,
Right.
businesses did get hit, but as far as markets are concerned, the bounce back was quite ferocious. So,
Sure.
whatever fall we had, it more than made up in the next 6 months itself. So, between March and August, we had made up for the
Mhm.
fall. And from there, it's
Mhm.
not looking back. So, what hit a low of 7,700 on Nifty and maybe sub 30,000 on Sensex is already
Mhm.
60,000 on Sensex and 18,000 on Nifty. So, I don't think any
Correct.
investor is complaining. Probably the people
Correct.
who weren't invested are complaining, or who are waiting for a fall are complaining, or are just
Mhm.
have a fear of missing out. And I think the best way
Mhm.
to address that fear of missing out is to have a portfolio of ETFs in your overall bouquet. So I think from an
Okay.
investor standpoint, we have seen investors in India
Mhm.
increase the number of demat accounts. We have
Mhm.
seen
Right.
demat account number going up from 5.5 crores to 7 crores, which is a huge
Mhm.
shift in the
Right.
last 6 months. Which
Mhm.
in fact tells us that people are interested in investing in equities, but we should be smart
Mhm.
enough. As we move along in this conversation, of course, we'll look
Mhm.
at the aspects of asset allocation and risk as well. But today, if we look at it, India is one of
Mhm.
the countries where mostly everything is looking good in terms of economy, in terms of
Mhm.
optimism, in terms of consumer demand, in terms of demographics being in our favor, and most
Mhm.
importantly, everyone else outside of India wants to
Mhm.
invest in India because there is no other
Right.
destination where they can invest.
Mm.
China is going through its own soft patch. Rest
Mhm.
of the world is not growing as fast. So ultimately,
Mhm.
that's where India stands out. And with the right policies which the government is bringing out, the
Mhm.
erstwhile sectors which weren't doing well, be it infrastructure, be it manufacturing, they are also now helping add to the GDP. So till about
Mhm.
last year, we were seeing only the services sector adding to the GDP. To an
Mhm.
extent, government sector was adding to GDP, but manufacturing was not, infrastructure was not,
Okay.
real estate was in a very bad shape. Today,
Mhm.
everything is firing at the same time. That is reflecting in the
Right.
markets as well. So, from a
Sure. Mhm.
sectoral perspective, if I have to say, basically, there are India is blessed, and we are all blessed with so many sectors being
Mhm.
large that they are
Mhm.
investable. If you were in a
Mhm.
country like South Korea, it would be only about probably electronics. If you
Okay.
were in
Mhm.
Indonesia, it would be about metals, or let's say iron ore. But in our
Mhm.
banks in India, we have everything. We have one of the largest information technology sector, the
Mhm.
largest pharma sector. So as an
Mhm.
investor, you never have a dearth of opportunities to invest in the
Opportunity.
market. If one thing
Mhm.
doesn't work, the other thing will work, and that's why today
Mhm.
we believe that for the last 1 year, pharma hasn't done well. So you can participate in the pharma story through the ICICI Prudential Healthcare ETF, which is there,
Mhm.
which can be a good fit for your portfolio. And as you
Mhm.
know, ETFs are very simple to buy and sell. I'm sure we'll come to the basics
We'll
of
come to
ETF
that.
as we
Yeah.
move along. But
Mhm.
from a sectoral perspective, pharma is looking good. Infrastructure as a story is looking good because India is going to spend 100 lakh crores over the next 3 years, and
Correct.
most
Mhm,
of the companies will benefit out of it. And
mhm,
of course, banking. No country can grow without banking, and that's where
mhm,
the private banks are gaining from strength to strength. We've seen the
mhm,
results also coming out, and they
mhm,
are on the positive direction. So the ICICI
mhm.
Prudential Private Bank ETF can also be a good fit for the long term for investors. So I
Mhm.
think there are enough opportunities and there are enough
Sure.
products within that
Mhm,
for you to participate. But
mhm.
make sure that your asset allocation is right. And I think we can continue with your further questions, Deepika.
Perfect. So I think, Chintan, before maybe we talk a little bit about asset allocation and investing, I think, given what has happened in the previous week, a lot of people would also like to understand these intermittent corrections and crashes that happen, right? They kind of shake investor confidence, especially because this rally has been fairly long in nature, right? तो सब wait कर रहे हैं कि भाई वो correction कब आएगा, and these intermittent crashes sometimes, scare or spook investors. How should one approach such sort of market, these intermittent movements in the market from an overall
So
portfolio
investors
perspective?
who haven't followed
Mhm,
investors who haven't followed asset allocation, who
mhm,
haven't been disciplined in investing, they will end
mhm,
up feeling the pain when the markets crash the way they do. And
mhm.
this wasn't even a crash, it's just a correction, I would say, and that to a
Sure.
minor one. From the
Mhm,
peak, we are hardly 4% down, which or
mhm.
5% down maybe, which actually has no significance as such when the rally
Correct.
has been almost 140, 150% from the bottom.
Absolutely.
So the
Mhm,
kind of rally that we've seen, such corrections are expected. They
mhm,
basically happen and they basically keep the weaker hands in the market basically get
mhm,
shaken out. But if you have your asset allocation plan right,
mhm,
you will not
mhm,
need to worry about market falls. And
mhm,
you are in the right sector invested or you are in the right set of stocks, you don't have to
mhm,
worry. Yes, if you have only mid and small caps in your portfolio,
mhm,
the last 20 days you probably not had a good run. But if
mhm.
you have a balanced portfolio in terms
Correct.
of your overall allocation, you don't
Correct.
have to worry. So these corrections do keep coming. Do I see a
Mhm,
major correction or do I see a major fall?
mhm,
Currently, there is no reason for us to
mhm,
believe that there is a
mhm,
major fall coming. But yes,
mhm,
valuations are not cheap, and hence
mhm,
investors
mhm,
should be careful of not
mhm,
having too overexposed towards the equities as a let's say segment, and they should have a
mhm,
good combination of equity, debt, and gold as part of
mhm.
your of their overall allocation.
Perfect, perfect. I think that makes sense, like you said, diversify so that any one asset class movement does not have a big impact on the portfolio. Great. So I think let's also now move on to we've heard so much about active investing is well known, right? Everybody knows कि active investing से पैसा बन सकता है. But what is this whole idea of passive investing? What is the approach from a fund manager point of view and from an individual investor point of view? How can I capitalize on this?
Yeah, so Deepika, as markets have evolved globally, if we
Mhm,
see
mhm,
about 150 years of history is there in US in mutual funds.
mhm,
They were predominantly active. In other words, whatever money is given by the investors is
mhm,
managed by the fund manager actively by buying and selling stocks, weightages of stocks, different
mhm,
sectors are chosen by the fund manager depending on
right.
whatever is the objective of the scheme.
Mhm,
Since 1960s in America,
mhm.
there was a wave of index-based investing, which
Okay.
has picked up in the last 15 years in a major way after the global financial crisis or the Lehman crisis in 2008.
Great.
So if
Okay.
we see what has happened after 2008 in US, which obviously whatever happens in the West in general or whatever trends happen in the West, they do get reflected in India as well. And that's what
Correct.
is happening in
Mhm,
the last 4 years. So since
mhm,
2008, we've seen the trend of passive investing pick up. So the institutional investors, the large investors in
mhm,
America and
mhm,
in Europe are
mhm,
investing through the passive route or the ETF route in the equity markets. And hence, last year, for the first time, the passive
mhm,
investing or the passive AUM or the assets
mhm,
under management in passive that
mhm.
overtook the active AUM in America. So you can
Okay.
imagine 150 years of active fund management, and in the
Mhm,
last
mhm,
15 years, passive has overtaken active. So that's a big disruption which has
indeed.
happened in
Mhm,
the mutual fund industry in America, and in India, it's no
mhm,
different. If you see in India, the
mhm,
passive investing, which is ETFs, have gone up
mhm.
to as high as 4 lakh crores of AUM, which was
Okay.
less than probably 10,000 crore in AUM 8, 9 years back. So you can see the
Wow.
sharp
Okay.
uptick which has happened in passive investing or
Mhm.
ETF investing in India. And it is
Mhm.
no surprise because, as you know, ETFs are very transparent. You know exactly as an investor what you are getting into. The
Mhm.
weightages are similar to the underlying benchmark. It is
Mhm.
very cheap relative
Mhm.
to any other form of investing. And since there
Mhm.
is no fund manager involved, it can be cheap, or it allows itself to be cheaper on the cost
Okay.
curve, or the expenses are lesser. So all that
Mhm.
an investor needs is a demat and a trading account, and much similar
Mhm.
like you're buying a share or security,
Mhm.
you can buy a ETF. And the
ETF.
beauty is
Mhm.
that you can buy one unit. So in one unit, you can practically get the entire exposure towards, let's say, Nifty, which otherwise you would have taken a higher amount for you. So you can
Okay.
participate on a daily basis, on a monthly basis, on a weekly basis. It makes it easier for investors to invest in a basket of securities because most investors do not have
Mhm.
the capability to research, to buy their own
Correct.
stocks.
Mhm.
Uh, Obviously, right now in the last 15 months, practically every Indian has become a fund manager and they're able to
Of
generate
course.
returns. But when the
Mhm.
markets fall the way they have in the last 10,
Mhm.
20 days, probably people
Mhm.
realize that it's after all not that easy.
No
And hence
choice.
having a basket
Mhm.
approach. So I would say that in India, given that India is a growth market, active
Mhm.
and passive both have a strong fit into an investor's portfolio. So it's not necessary that you take out your money from active, but
Mhm.
incrementally, a mix of active and passive is something which we would recommend.
Perfect. So, Chintan, you mentioned about diversification, and that was my understanding too, right? That when you invest passively, let's say you invest in an index ETF, right? So you get exposure to all the constituents of the ETF. So even from a portfolio perspective, we've always told that diversification is good, right? So is this something unique that a passive fund or an ETF will bring? This ability to diversify portfolio through one single investment?
Absolutely. So if you pick up, let's say the ICICI Prudential BSC 500 ETF, right?
Hmm.
If you pick that up, you have basically all the 500 securities which are there in India, the top 500 securities, part of the BSC Sensex, BSC 500 index. In one go, you will end up getting it, and you can buy it in smaller unit sizes. So it basically diversifies your portfolio and allows you to
Mhm.
participate in 500 companies. Otherwise, if you have to buy one company, many of the shares are 100 rupees, 1,000 rupees, 10,000 rupees. You will not be able to even buy them. But as part of the
Correct.
portfolio, you
Mhm.
do get some exposure to these names. And history has suggested
Mhm.
that more than 90% of the people you will be able
Mhm.
to beat by just simply investing in a passive manner in an index or an ETF
Mhm.
of the broad market. So many people
Mhm.
try to be smart, many people try to, it's okay, you are interested, you want to do that,
Of
you
course.
can do that in
Yes.
terms of
Uh-huh.
trying to generate alpha or trying to make money
Mhm.
out of markets by actively investing through your own
Mhm.
research. But it's a
Mhm.
much more simpler way or a mental piece that you will get, that you
Mhm.
invest in an index or you invest in
Mhm.
an ETF which is following an index. It either gives you 50 names or 30 names or 100 names depending on what the benchmark index is. Just to highlight, if
Mhm.
you invest in a
Uh-huh.
Nifty 50 ETF, you get
Mhm.
the 50 names of Nifty. If you invest in a Sensex 30, you get the 30 names of
That's right.
Sensex. And if
Mhm.
you invest in the BSE 500, you get all the 500 names. If you invest in the Nifty Mid Cap 150 ETF of
Mhm.
ICICI Group, you'll get the 150 mid cap names. So if you want to invest in mid cap, you have a solution in the ETF
Mhm.
space. You invest in large cap, you have a solution. So
Solution.
apart from the
Mhm.
sector and themes, the large caps itself or the mid caps itself and the
Mhm.
diversification can be done through ETFs. And it's a
Mhm.
very cost effective way also because most of these ETFs are less than 20 to 30 basis points in annual recurring costs. So from an
Okay.
investor perspective, these make perfect sense and they should be a part of all investors' portfolios.
Excellent, excellent. So, I was going to ask you from a cost perspective what makes them more compelling, but I think you have also highlighted that. And one of our viewers has a very interesting question, which I was going to ask you whether we can do an SIP in an ETF, but he's asked us, which is a better way to invest in a mutual fund scheme through lump sum or SIP. So maybe first you could just respond to my question, ki, can I do an SIP in an ETF? And then of course our viewers as well.
Yeah, so the traditional way of doing an SIP is in a mutual fund where every month, every week, or every day, depending on
Mhm.
what the mandate allows in that particular fund, you are able to, if the money goes from the bank account to the index fund. In the
Mhm.
case of an ETF, since you need to buy it on the exchange, There are broking
Mhm.
firms which allow you to participate. You just register and they allow you to participate on a weekly basis or a monthly basis, as the
Okay.
case may be,
Mhm.
with units.
Mhm.
So it's called basically systematic equity investing, or they have this systematic equity plans wherein you
Mhm.
can buy
Okay.
few units, so you can
Mhm.
pre-decide how many money or how much units you want to buy. ETFs,
Mhm.
you'll not be able to do a systematic investment plan the way you do it in mutual funds. But
Okay.
through the broking firm platforms, most broking firm platforms allow you to do
Mhm.
that in ETFs, and you can invest systematically in them.
Okay, thank you. Okay, and then coming to our viewers' question, just overall, some perspective of when a lump sum investment might be better and when an SIP approach might be better.
Yeah, so Deepika, in our monthly fact sheets, for those
Mm-hmm.
investors who actually are mutual fund investors, would know that there is a fact sheet, or there is a, let's say, a document which comes
Mm-hmm.
every month, which
Mm-hmm.
discloses what we own in the different funds that we have. There is a
Sure.
commentary which we give at the beginning of that fact sheet. In that
Okay.
commentary, we
Mm-hmm.
basically disclose a table in which the
Mm-hmm.
market valuation based on
Mm-hmm.
certain parameters is codified into an index. So in that index, we call
Mm-hmm.
it the equity valuation index. If the equity valuation index is in the green zone, that is the
Mm-hmm.
first two. So there are five levels in that particular index. So
Mm-hmm.
first two levels are green zones. You can pretty much invest lump sum. The third zone
Okay.
is a neutral zone, or an amber zone, as we call it, where you may or may not want to invest in lump sum depending on where we are right now. It is in the fourth zone, so we wouldn't recommend lump sum investment unless you are 0% in equity. So ultimately it all boils down to how much you are invested in equities, and that's where the starting point will be. If you have 0% investment in equity,
Mm-hmm.
obviously I will say you can go up to 5% invest lump sum. But if you're already
Sure.
20, 30, 40% invested in equities, then
Mm-hmm.
SIP is better. But in general, what we've noticed is that
Mm-hmm.
we earn money every month. Most of us, we save
Mm-hmm.
after our expenses. As part of
Right.
our part of our savings, if a certain portion we can invest systematically in the markets, it makes
Correct. Yeah.
perfect sense. And
Mm-hmm.
lump sum, whenever the markets have a significant fall, as we say,
Mm-hmm.
whenever there is a discount in the markets, don't
Mm-hmm.
run away from the markets. We've noticed more often than not that if there's a big $1 billion sale in any of the online shopping apps, people rush towards it. But if there is a big $1 billion sale in the equity
The
markets,
market
people are against it.
run
So
away from
let's
it.
keep
Yeah.
that mindset whenever there is a big selling, like we've seen in the
Mm-hmm.
last maybe 7, 8 days also.
Mm-hmm.
It's
Mm-hmm.
good to maybe invest or start investing in lump sum right now if you have a longer term view and you don't have equity exposure. Ultimately, it boils down into how much equity exposure can you afford based on your risk reward profile, responsibilities, current income, and what are
Mm-hmm.
your requirements, and then you basically decide how much should be in equities. And once you've decided that, have a good
Mm-hmm.
mix of active and passive, right? Because in active also you have many options to invest, in passive
Correct.
you have many options to invest. Have a
Mm-hmm.
good mix of both. I think you should be fine. For most investors, the
Mm-hmm.
following works. For most investors, the following will work. Have 50% of your portfolio in dynamic asset allocation fund or the balance advantage fund category. The
Mm-hmm.
balance 20% you can have in the flexi cap, a fully invested fund category, or you can have it in value category. The 50 plus 20 is 70. Then you'll have 10% in international markets, which is fine. You can
Mm-hmm.
have 10% to 15% in ETFs or index funds, and the balance 10% you have it in gold. So, of course, for each investor it will be different, but general rule of thumb:
Mm-hmm.
50% in dynamic asset allocation funds, 20% in fully invested active funds, 15% in maybe ETFs, 10% in gold, 5 to 10% in international markets. So if you want more exposure to international markets or more exposure to ETFs, then you
Mm-hmm.
cut your pure equity exposure on the active side. But having a
Mm-hmm.
50% core in dynamic asset allocation will ensure that your overall portfolio experience in the long run in terms of risk and reward will
Mm-hmm.
look better. Today, everyone is only looking at past returns and thinking that, okay, I should have every single penny of mine in equities. I would have been a very
Equity.
rich person. Those
Correct.
same
Mm-hmm.
people, if we circle the time back to 2020 March, they would
Mm-hmm.
end up probably feeling the exact opposite. Why do I have
Correct.
equities? So
Correct.
managing
Right.
emotion is managing about your asset allocation, and that's where
Mm-hmm.
please ensure that you are disciplined and you have your emotions in check through a
Mm-hmm.
proper asset allocation plan, and where I'm sure India Infoline or 5 SR team can actually help you make the right
Mm-hmm.
balance.
Perfect. Thanks. Chintan, you have laid it out so clearly. I think everybody who's listening in right now would. There is this one, I think, the thing you pointed out about the SIP and lump sum and the zones that you mentioned. I think that is very unique. I have not before approached SIP from that point of view. Ki how much equity exposure you already have, and then accordingly basis also the market levels. That's a very unique approach. I think many of us would have not heard it before, so thank you for that. Also, you mentioned a little bit of allocation towards gold. Can we have some sort of view on gold as well from you?
Yeah, sure. So, gold as a commodity, if we see Deepika over the
Mhm,
last 1 year, it is down, I think, 7%, while equity markets
mhm,
are up 60%. If I look
mhm,
at last 10 years in India also, 2011, if I remember correctly, gold prices were 33,000. Today they are
mhm,
47,000. So just a
mhm.
rise of about 40% in the last 10 years,
10
which
years.
probably
Mhm.
is less than what you would have made in fixed income, or simply
Okay.
by keeping money in savings account or savings accounts. So the
Mhm,
idea is that gold has had a lost decade in the last 10 years.
mhm,
And in this same time period, if I have to just give some numbers for those audience who are probably interested in numbers,
mhm,
uh, the debt, the global debt today stands at $220 trillion. $1 trillion
mhm,
is equivalent of 75 lakh crores. So
mhm,
what global debt is $220 trillion. Global equity market cap, the sum total of market valuations of all the companies which are listed,
mhm,
predominantly it is in US, of course,
mhm.
that is about $110 trillion. So
Okay.
$220 trillion of debt outstanding
Mhm,
in the world, $110 trillion of market cap of equities
mhm,
outstanding in the world. Compare that with the gold available in the world, which is mined till now in the last 100 years. That is
mhm.
only $11 trillion. So think of
Wow.
it today that we've had one of the best rallies in equity markets, one of the best rallies in bond markets because of the easy
Mhm.
liquidity policy, because of the 0% interest rates.
Right.
If you make money free, obviously that
Mhm.
money is going to flow into risk assets, and which is what we've seen equity markets
Correct.
going up very sharply. In the last 10 years alone, the
Mhm.
equity market valuations have added $50 trillion. So $50 trillion of wealth has been added in equity markets in the last
Equity.
10 years.
Mhm.
And
Mhm.
the available gold in the world today is only $10 trillion. So you can imagine that even if a slight shift happens from equity or debt, because when
Mhm.
interest rates go up, and they are likely to go up in the next 12 to 24 months, the
Right.
debt markets
Mhm.
obviously will see money going out. And if the debt
Mhm.
markets see money going out, it can potentially lead to either coming into equities, but then equity valuations are not cheap. So then
Sure.
where will it go? It will go into gold. I know there
Gold.
are other asset
Mhm.
classes which have become popular today, and they are
Mhm.
probably taking away some sheen out of gold. But then gold
Mhm.
has stood the test of time for the last 5,000 years. It is the store of value. It cannot be printed out of thin air. It cannot be mined
Correct.
by computers.
Mhm.
It cannot be
Mhm.
mined by computers. So gold is something which should be a part of investors' portfolio. And we
Mhm.
believe that 5 to 10% of your, or let's look at it the other way, which I was
Mhm.
discussing a few days back in one of
Mhm.
the other webinars. If
Mhm.
100 rupees you invested in equities have gone to 160 rupees, why not
Mhm.
take out 20, 30 rupees out of that? Whatever
Mhm.
gains you made, take
Mhm.
50% of the gain. So 100 has become 160, 30 rupees out of that, take it out, put it in gold. What will happen is if there
Mhm.
is a volatility, if the markets fall the way they have, gold will not
Mhm.
fall. So markets have fallen 5 or 6%. Gold is probably there and thereabout. And eventually,
Mhm.
if there is a big shakeout in the equity markets because of whatever happens globally or otherwise, gold tends
Mhm.
to fall first, but it's the first to rise because the safe haven investing, it's considered as a
Correct.
safe haven or a safe
Mhm.
investment when there is volatility. Even a
Mhm.
slight move, even $1 trillion moves from either debt or equities, which is
Mhm.
small. So for debt and equity, $1 trillion is nothing. Like I said, $220 trillion,
Mhm.
$10 trillion,
Right.
it's minuscule. But
Right.
for gold, which is available, it's only $10 trillion. So you add $1 trillion, it's a huge
10%.
delta which is
Mhm.
possible.
Mhm.
So it's
Mhm.
not impossible to think that gold can rally in the next 10 years, especially in an inflationary environment that we are, with
Mhm.
aluminum, copper, zinc, crude, agri commodities, every price going up. If
Mhm.
every price is going up, inflation is
Mhm.
bound to raise its heads, and inflation in India is raising its head. In Europe, it is at a 14-year high. In most
Mhm.
countries in Europe, inflation is at a 14-year high. So we cannot ignore that. And the
Correct.
best friend
Mhm.
for investors in a low interest rate environment in a high inflation world is
Mhm.
essentially gold. And hence,
Mhm.
for most investors, we say incrementally, if you are wondering where to put your money, put it in ICICI Prudential Gold ETF, put it in ICICI Prudential Regular Gold Savings Fund. So you can either put it in an ETF if you have a demat account, but assume if you
Mm-hmm.
don't have, most of the
Mm-hmm.
viewers here, of course, will have a demat account, so there's no
Demand, yes.
question. So you
Mm-hmm.
can basically, have a gold ETF being added into
Mm-hmm.
your portfolio
Mm-hmm.
as we move along over the next few months. And eventually, it will
Perfect.
help your overall portfolio balance. It will hedge your risk of equity markets falling. It will hedge your risk of volatility in markets, and also
Mm-hmm.
allow you to create wealth as we move along. Just purely, if you see the underperformance of gold, and we have so
Mm-hmm.
little gold relative to the rest
Mm-hmm.
of the markets, that is the equity
Correct.
in debt, that gold is
Mm-hmm.
something which stands out.
Perfect, perfect. Thanks, Chintan. I think what you just mentioned in terms of why gold should be a great investment avenue, and especially that thing which you mentioned about why don't you take some of the money or profits that you've made on the equity side and reallocate it to debt, sorry, to gold. It's uh, it's really nice because often this is a problem which everybody faces. Ki once you make money, where do you reallocate your gains? And when do you exit and start reallocating because you don't have good investment options? So that's great. And of course, I just want to reiterate for the viewers as well that gold ETF specifically is a good approach or a good avenue for people who want to take exposure to gold. Perfect. And then I think we've had a very comprehensive discussion. While we started off with passive investing, I think some of the nuggets that you provided in terms of SIP and gold and asset allocation and rebalancing have been fantastic and specifically unique. Anything that you would like to wrap up with? Any last points that you would like to share with our viewers?
Yeah, so number one, don't underestimate the importance of a financial advisor in your life. That will help you
Mhm,
to basically enhance your long term wealth. Second is asset allocation. Sounds jargonist, sounds
mhm,
complicated, but it is
mhm,
nothing but what I simply mentioned right now. If you made money in equities, 100 has become 160, you're taking out 20, 30 rupees, putting it in gold. That
mhm,
simply is asset allocation. So at every given interval of 6 months, 1 year, or whenever there is a big dislocation in the markets, go back to the drawing board, see what
mhm,
your asset allocation plan is, and once your asset allocation is set, you'll know exactly where to take out money from, where to invest. And today, as
mhm,
things stand, I am seeing an under investment. So back in 2013, 14, 15, when I used
mhm,
to interact with investors, there was an under investment in equities. Today, if I see there is
mhm,
an under investment in gold, and at a time when interest rates are so low, it makes perfect sense to start
mhm,
investing in gold. And gold is an asset class
mhm,
which I don't think anyone would complain about. So,
mhm,
from an investor standpoint, I firmly believe that while Diwali is a time, or Dhanteras is around the corner,
mhm.
and you would be buying jewelry, and
Correct.
that's something which you should do. I believe it makes your people around you happy, but
Mhm,
don't ignore the importance of gold as a financial investment. And to
mhm.
that, the ICICI Prudential Gold ETF is something which you can look at, because there you are getting it in a form where you don't have to worry about the physical
Correct.
storage. You don't have to worry about the security, the
Mhm,
purity, and of course, it is liquidable any time that you want.
mhm,
So
mhm.
it's just a simple way to start investing. And unlike when you go to a jeweler, you may need to buy a larger chunk, and there are costs which are higher.
Correct.
Here you can
Mhm.
buy it in smaller unit sizes depending on whatever is your appetite and whatever is your savings. So that's the advantages, and don't miss out on that. Thank you.
Perfect, perfect. Thank you very much for that fabulous session and that great summary, Chintan, for joining us. Very, very happy Diwali to you. Very bright and shining Diwali to you. And thank you, viewers. Happy Diwali to everyone. And we shall see you next Friday. Thank you.
Happy Diwali to all the viewers as well. Thank you. Cheers.
Great.